Good afternoon. How's everyone doing? It's Friday once again. It's crazy how fast time goes. I talk about that every time. I don't know why I say that, but I'm always amazed it's already Friday. But hey, it's good. You know what? We're coming out of a deep freeze here on the Front Range of Colorado. Hopefully wherever you're at and watching this, it hasn't been as cold there as it is here, although I've got some clients in Anchorage, Alaska, and I can't complain because they've been like sub-zero for most of the winter, which they didn't really have a summer, had no fall, and went directly into winter. And it's been an Alaskan winter up there, they tell me, which God bless them for that. I like the cold, but maybe not that much. But anyway, before I kick things off here, I've got to throw out the disclosure to keep the compliance people happy. So the information on this show is for informational purposes only. I call it educational, is what I call it. It is not meant to be advice in any way, shape, or form, whether it be investment advice, tax advice, legal advice, or any other type of advice that may come out of my mouth. The information that is delivered on this show is anticipated or expected to be truthful, although I cannot promise that, and that's just because I have to say that. But I will tell you this, it is truthful because I am all about the truth, and investments can and will lose money. They are not FDIC insured. And without further ado, we're going to get this going. I have a really good show today. There is lots of stuff going on. January, awesome month in the markets. You think, what are you talking about? It was crappy. Awesome. All sorts of really good things going on, and I'm really excited to share them with you today. So today, here's what I got. Top 3 things, and I've got a 4th, which are the things that make you go, Yes, I've always got to have those. That's my new thing. Johnny Carson had his cards. Dave Letterman had his cards. Krager has his things that make you go, Jimmy Fallon has thank you notes. I think mine are better. What can I say? Anyway, we're going to review today the number one thing we're going to focus on is we're going to review the consumer income statement and what it means for 2022. Is the consumer as healthy as is thought out there, or really not discussed? I think not, but we're going to talk about that. We're going to talk about 2021 performance year end relative to the start of the year. Big changes already lurking, as many of you have been hearing me say for quite some time, that there's just some things under the surface that aren't quite what they seem, and they're not. Going to close that out with current Wall Street positioning, really looking at the Commodity Futures and Trading Commission. It's the CFTC reports and how Wall Street is positioned. It's kind of a great way for us as people to see what Wall Street is doing. The CFTC uses it from a standpoint of holding Wall Street accountable and really trying to protect public fraud and manipulation in any type of abusive nature or practice. So we're going to talk about that, and then I'm going to close it out with the things that make you go, So anyway, to get rolling here, lots of interesting stuff about consumer income statement. I've got my cheat sheets here so I can be accurate on my data. The last 2 years, so this is 20 and 21, we saw income per capita increase by $7,300. Okay, this increase was mainly driven by personal transfer payments, which was made up mostly of government stimulus and social benefits. So big chunk of that $7,300, $5,200 to be exact, was made up of government handouts. Okay. Now, when you look at retail sales, 2021 had the largest single year increase on record. Now, when you say something is an all-time high or an all-time record, that is a big deal. Now, you have to also take that tongue in cheek with what happened in 2020. 2020 was a disaster from a retail standpoint. That was the pandemic year. That's when everything got shut down. Economy comes to a screeching halt and then reopens. So you can understand why, but it's the impact of that, okay? What I find even more interesting is how when you look at consensus expectations from a standpoint of looking at retail sales across the border, they're really expecting 4 to 5% growth over the next 3 years or so, with really out any type of change in what's happening. And that's what I just think is really garbage, and I think they're missing it, okay? When you look at savings rates, you saw savings rates grow at a 16% clip in 2020. that rate went down last year. So you saw savings rates go from a plus $4,962 to a negative $2,039. Okay, when you factor in wage growth, you factor in government stimulus and social program support, and you factor in all the savings where they saved those dollars, it makes sense in connecting the dots why retail sales for 2021 was so huge. We had, you hear this pent up demand, or they talk about pent up whatever. It's kind of a buzz term that's used. You can understand why retail sales were so massive in 2021. Now, as we go into 2022, the kicker is everyone has spent everything that they saved, and now what do we have? We have prices that have climbed up to uncomfortable levels, and it's going to get more uncomfortable. We've just started to see on the news at night on how much they anticipate grocery prices to go up. It's like, this is a shocker? Seriously? It's not a shocker. So I'm amazed at that. But I think that is going to lay the groundwork for what could be a very challenging year in the 2022. So going to be interesting. Moving on. Let's look at performance. I'm going to start out with overall. These are all the different market sectors in 2021. Commodities led the way up 37%. S&P was up 26 and change. NASDAQ up 21 and change. Dow Jones up 18 and change. Developed markets, which is international, not the U.S., was up 18 and change. The U.S. dollar was up 6%, 6.37 to be specific. T-bills were flat. Emerging markets were negative 0.2. U.S. bond ag, that means bonds. Bonds are safe. Well, bonds were down 1.54% last year. Gold last year was down 3.6% for you gold bugs. Treasury bonds, which are long-term bonds, were down 4.65. Negativity for bonds, always painful. Where are we at year to date? This is through January 31st. Commodities again strong, up 11.6. This is going to tie into my Fed commentary here in a little bit. The U.S. dollar is up 1%. T-bills flat. Emerging markets minus 1.79. Gold minus 1.8. The Barclays bond ag, which is broad investment grade, minus 2.1 to add to the 1.5 from last year. The Dow's down 3.3. Developed markets down 3.6. T-bonds down 4.1 just year to date. The S&P 500 is down 5.1. Actually 5.26. The NASDAQ is down 8.98. All that tells me is ouch. That's all I have to say. That is all. Let's break down bonds specifically. In 2021, where would you make money in bonds? You would have made money in high yield. High yield was up 5.28. Municipal bonds were up 1.5%. T-bills were flat. Everything else was down. Starting year to date, T-bills are flat, up 0.01. I know that's something to write home about. Everything else is down. Okay, this has been a very challenging start to the year and a very challenging environment for asset allocation. Okay, I have people say, well, Craig, I talked to my friends and they made so much money last year. Here's what I will tell you. They probably owned Apple, Facebook, Amazon, Google, Tesla, Facebook. I probably already said Facebook. They probably owned those companies. They're the most widely held companies on the planet. Okay, which also tells me they were probably exposing themselves to a significant amount of risk that they were really unaware of. Because when things are going up in a straight line, you know what? We don't understand the risk we're taking. And again, we've had so much government pump since the financial crisis and since the pandemic that I think people have begun to forget about risk exposure. For many of you, if you're my clients, you received a risk profile questionnaire. If you're hearing me say this, you haven't filled it out, shame on you. Fill that sucker out and send it back to me. It's really good. It helps us gauge and understand what our risk profile is, because then that ticks and ties directly into your asset allocation. Going back to performance last year, if you were a moderate investor, okay, my guess is you were probably up 7 to 10 to 12%, and that's it. Why? Because of the bond exposure being negative and offsetting your equity gains. You have to understand that relationship because it is real. Okay. Year to date, sector wise, what is up year to date? Energy's up. Why? From oil. Why? Think you should all send Vladimir Putin, the dictator of Russia, a thank you note for threatening to invade Ukraine, because that's what's kept oil up. The only thing up were financials, and there's this assumption that normally when interest rates are rising, which they have been, that's good for financials, but it's not good when the yield curve is going to flatten, because if the Fed is talking about raising rates like they are, we're going to see this yield curve flatten in a hurry. And what I mean by that is this. Right now, you've got Fed funds rate or short-term rates at basically zero to 25 basis points. They are talking about 4 to 5 rate hikes in 2022. What I get concerned about is this. First of all, the market is telling the Fed what it thinks, which right now it's, not too hip on Chairman Powell raising rates 5 times. Okay, that's what's enhanced and changed the volatility paradigm. We went from a declining volatility environment to a rising volatility environment starting in mid-December, and it's been picking up speed since then. I don't look for that to change through the first half of this year, particularly if the Fed starts raising rates. What's sad is we're starting to see data out there that the Fed is looking at. I give the best example of how the Fed looks at data. It's like driving your car, looking in the rearview mirror. Is that safe? No. My dad used to smack me in the arm going, hey, check your mirrors, but don't spend a lot of time there. Well, all the Fed does is lock in the rearview mirror. What they're seeing now is inflation is elevated. Yeah, it's rising. It is also beginning to roll over. They're not seeing that. Why? Oil is kind of a linchpin. If oil remains elevated or continues to rise, we're going to see the Fed get in there and start raising rates. The kicker is this. I don't think they have the guts to do what they need to do. Paul Volcker back in the 1970s, he was the Fed chairman at that point in time. And for those of you who are 60 years of age and older, you probably remember it much more than I do. I was a snot-nosed kid in grade school and middle school in the 70s, okay? I don't remember a lot about inflation and interest rates other than what I have read from a historical standpoint. Those of you that lived it remember very high interest rates, 14 and 15% interest rates on homes and higher. Money market rates, CD rates at 14 and 15%. We had inflation that was off the charts. What did Volcker do? He had the guts to go in and raise rates so hard and so fast that he put the United States economy not into just one recession, but 2. Fast forward, every Fed chairman since him does not have the guts to do what he did, okay? Here's how Craig predicts Fed Powell and our government to react going forwards here. This will be my unbelievable Broadway level presentation of what Fed Chair Powell is going to do. I need to get a drink because I'm really getting fired up now. Here we go. First rate hike for the people of the United States of America is going to come in March because inflation is a problem. You all are spending more money when you go to the store, and it's getting more expensive, and we're worried about it. So we're going to hike interest rates 1/4 point. Going to come around to the next meeting in April. Most likely, not a whole lot has changed other than the markets are going, we're not sure we like this, Mr. Fed Chairman Powell, but you have to understand, side note here, this is the narrator. Fed Chairman Powell, A, he's a lawyer. 2, he used to work for a company called Carlyle. He made millions and millions of dollars on Wall Street. So at the end of the day, is he going to do what he needs to do? Or is he going to listen to Wall Street? Right now, he's trying to do what he needs to do. He did this in 2018. At the very end of the year, he raised rates 3 times. What did the market do? Fell off a cliff. So back to, as Fed Chair Powell, I'm back in character now. This is April of 2022, and due to rising inflation, we are trying to control inflation for the American people. And we're going to raise rates again, another 1/4, maybe a 1/4 point, maybe a 1/2. That's what's going to happen next. At that time, this is the narrator again, the economy is going to be decelerating and starting to decelerate quicker. You're also going to see inflation begin to decelerate, of which they're not going to really be aware of because they're looking where? Rear view mirror. They're going to start raising rates at the absolute worst time. What did I say the last time that I was on my show? I was worried about policy mistakes. They're going to make one. The kicker is how bad, okay? We are now a country that is adverse to pain, okay? There was a saying when I grew up, no pain, no gain. That's legit, okay? I played sports. I played college sports. I was a quarterback in college. You know what? I've been in this business. I started my own company. No pain, no gain. That is legit. Sadly, what the government tries to do is remove pain. People do not have a pain threshold any longer. So what I see is them trying to do the right things at the start, and I think the markets are going to hate it, and I think you're going to see them cut rates right back to zero, and then I actually think the markets are going to take off. So it'll be a really good time. Because when you cut interest rates, you're trying to do one of two things: A, control inflation, or B, slow the economy down. If you're trying to control inflation into an already decelerating economy, it's like driving your car down I-25 at 80 miles an hour and you pull the emergency brake. That's what he's going to do. That is not cool, okay? So anyway, it takes a lot of energy to act, you know. I never did it anywhere else. So hopefully you appreciate my attempt and my passion for acting this out here. But I hope more than anything you say Model Blog's an idiot, but I learned something, and you know what to look for now and expect and anticipate. That's what you got to think about. Okay, moving on here. How is Wall Street positioned? I talked when I first got started off the show today about the CFTC, which is the non-commercial it's the Commodities Futures and Trading Commission, but they produce a non-commercial net long positioning. It's updated every week, and it informs anyone who wants to look at it. You can go to the CFTC site and find it if you can find it. Okay, thankfully one of my research partners gives this to me weekly. Right now, Wall Street is as bullish as they've been in the last 3 years on the S&P 500. They are also as negative about interest rates as they have been in the last 3 years. So you have Wall Street that is very long and bullish on stocks, very negative on bonds. This is where it gets interesting, okay? Because the Fed could roll all this over. We've already seen what volatility has done here the last couple weeks, okay? It's tough. It could get really tough, and I'm just telling you that. So what do? We don't panic. We make good, informed decisions based on the math, which is the rate of change, whether things are accelerating or decelerating. That is how I look at it. I've been subtly making changes since last November, December. And I really like how we're positioned right now. So we just got to hang in there. You got to wait for it to take and for things to happen. But I really think that we're going to be right. So anyway, close this thing out here. Things that make you go, I've got some good ones here. Trend spotting. Sports betting is at a peak high we haven't seen in a very long time. Okay. Here we go. People from the ages 21 years, and I got to look at my deals. So I need to go to the eye doctor. Because I can't see anymore. If you're 21 years of age and up, 12% of you bet weekly. Shame, shame, shame. 6% bet at least monthly. 7% at least or less than once a month. 76% never. These are really high. If you look at Americans under 45 are the most likely to gamble, 28% of those ages 21 to 34, 31 to between 35 and 44. Gambling is bad, okay? Why does Vegas sparkle so much? Because you go and lose. So that's not a good thing that we want to do, okay? Second thing that makes you go, I saw a clip here recently. It wasn't a clip, it was an article. And it talked about how President Biden, and for all of you know, if you're a Biden fan, don't be offended here and shut me off. I'm not a Biden hater by any stretch. I'm very in the middle from when it comes to politically. I'm not happy with either party. But I thought this was interesting how he put a tweet out there about how GDP growth compared to other presidents. His is at 5.9%. Trump's was at 1. Obama's was at 1.6. George W. 2.2. Clinton 3.9. First George Bush 2.2. Reagan 3.0. Here's where this is garbage, okay? This sounds just fantastic. Well, you have to understand, when you come out of a massive crisis and you go from a fall off a cliff economy like this country has never seen, only to see it snap back. So you saw a decrease of negative 3.5%, and then you saw an increase of 5.7%. This recovery is not the fastest, and then you say that it's the fastest in 40 years. It's not. It's called a bounce, okay? Just want to clarify that. And if you actually put this recovery in context, and this is actually an article, if you want the article, email me and I will send it to you. It's from a guy by the name of Daniel Lukai. He's an economist. He's a stud. He's from Europe. He's been with PIMCO, a bunch of big houses, and I love this guy because he's no BS. He said, if you really put this, and I'm going to read verbatim here, if you put this recovery in the context of the largest monetary and fiscal stimulus in recent history, with 2 record high deficit prints, with the Biden tweet, what the Biden tweet shows is the poorest recovery adjusted for debt and monetary support in many decades. So the Biden tweet states that this is no accident. He's right. It's basically going to be a train wreck. Anyway, last one here, Punxsutawney Phil, and I'm going way long, 21 minutes here. I'm just blabbing at the mouth today, but it's because it's so good. Punxsutawney Phil, just for you weather people here. If you really want to know, I kind of grew up a Farmer's Almanac kid, being from Kansas originally, but Punxsutawney Phil, he kind of trumps it all. When he saw his shadow a couple days ago, all that means is that we are going to have 6 more weeks of winter. So with that, you know the rest of the story. Another favorite person of mine, Paul Harvey. For Wall Street X's and O's for Friday, February 4th, 2022. It's always great to see you guys. Thanks for your time. I love you. And stay warm. And until next time, I am